Start an SIP investment of Rs 15,000 per month, continue the SIP for a period of 15 years, get 15% annual returns, and you become a crorepati. As per this strategy, you invest only 27 lakh rupees and end up earning 73 lakh rupees. This is what they call the 15-15-15 strategy of mutual funds. But is that really possible through mutual fund investing, or is that false advertising? In this video, we are going to discuss how investing in 3 to 5 good mutual funds can create massive long-term wealth, and more importantly, we are going to discuss how to devise a successful strategy for mutual fund investing. Failing to plan invariably means planning to fail. So let's devise a plan. Namaste and welcome to Retail Investing. Before we get into discussing mutual funds in details, let us broadly classify mutual funds into two categories. That is active funds and passive funds. A passive fund is one which just copies an index like the Nifty 50 index or the Sensex. Fund managers don't have to put any effort in stock picking. These funds are humble enough to accept the fact that they will not be able to beat the benchmark index. Hence, their fees or expense ratios are quite low. Active mutual funds are those funds in which a group of experts constantly keep analyzing all the shares in a mutual fund and keep reallocating them with the goal of outperforming the benchmark index. This outperformance is called alpha. Other than generating alpha, the main target of active mutual funds is to deal with the volatility in the market. That's because people tend to run away from funds which are highly volatile in the short term, irrespective of their long-term returns. In the past, mutual funds have been able to generate very high alpha, especially during bull markets. Let's have a look at some data. Between July 2003 and January 2008, the Sensex gave a CAGR return of around 48%. During the same period, the leading mutual funds in India gave a CAGR return of 58%. So 10 lakh rupees invested in the Sensex would have become 58 lakhs and the mutual fund investment would have become 78 lakhs. That is some big alpha. It has been noticed that in all countries, actively managed funds initially dominate the industry. Afterwards, when markets became more competitive or perfect, it becomes almost impossible for actively managed funds to outperform the benchmark index. Let's understand why that happens. So what is the meaning of a market becoming perfect? A perfect market is a hypothetical concept. Just like in chemistry, we have the concept of the ideal gas. In theory, a market is called perfect when all buyers and sellers have exactly the same information. There is no information asymmetry, which means that there is nothing that one buyer or seller knows which others don't. In reality, no market can be completely perfect or imperfect, but compared to the 90s markets, today there is very little information asymmetry. In the 1990s, many promoters were in secret partnerships with brokers to manipulate prices of their own company's stocks. Those promoters and brokers made insane amounts of money by fooling innocent retail investors. These practices kept retail investors away from stock markets for a very long time. Even today, only 3% Indians invest in stock markets. The market regulator SEBI has been immensely empowered in the last 20 to 25 years, and it has forced companies to make disclosures like never before. Almost every bit of important information is available in the public domain, and it's no more safe to rely on insider info. This makes it extremely difficult for mutual funds to generate alpha or outperform the benchmark index. European and US markets have evolved for more than a century and are now more developed and closer to being perfect than Indian markets. And that's why very few mutual funds in those countries are capable of outperforming the broad index. The Indian market is quite young compared to its European and US counterparts, and it has not yet reached those levels of perfection. Hence, it's possible that in the next 15 years, a handful of mutual funds will outperform the Nifty. But we must be very careful in picking a mutual fund because the majority of them will definitely underperform. Let's have a look at what options do we have. We will be discussing only the direct mutual funds. A direct mutual fund is one where we can invest directly without the involvement of any agent or broker. The plans which involve an agent are called regular plans, but I don't think they exist anymore. And also, all the funds we are going to discuss will be growth funds, which means all your profits will be reinvested into the fund and no dividends will be paid. Large cap direct growth funds. To be in the large cap category, a mutual fund has to invest 80% of its corpus in the top 100 listed stocks. Even multi-cap funds are required to invest most of their capital in large cap companies. The first mutual fund in my list is Quant Active Fund. This mutual fund has assets under management of rupees 4,061.77 crores. The minimum investment required in this fund is 5,000 rupees. Its expense ratio is 0.58%. It has generated a 3-year CAGR of 42.72% compared to 26.5% for the Nifty 50. Its 5-year CAGR return is 21.11% compared to 11.1% of the Nifty 50. The CEO of Quant Mutual Funds is Mr. Sandeep Tandon. This gentleman is supremely confident about generating alpha. If you look at the CAGR returns of this fund, he has clearly delivered. One of the reasons behind such high returns is that this fund recognized the leader of the last bull market at the right time. It was the Adani group of companies. Now I know it's controversial to talk about Adani stocks, but to be a successful investor, one must make all decisions based purely on data and setting aside emotions. Let's take example of Adani Ports. Adani Ports has already built such infrastructure that probably in the next 30 to 40 years, nobody can replicate it. Managers at Quant understood this at the right time and delivered very impressive returns to its investors. But instead of investing in the Quant Active Fund, I prefer its ELSS version, which has been named as the Quant Tax Plan, and there are 2 reasons for it. The Quant Tax Plan has a lock-in period of 3 years, which means inexperienced investors don't have the option of selling out at moments of panic. And secondly, it provides tax exemption under Section 80C of the Income Tax Act. Let's say your annual salary is 6.5 lakh rupees and you decide to invest 1.5 lakh rupees into an ELSS fund. That way, your taxable income for the financial year will be considered only 5 lakh rupees and hence you will not have to pay any income tax. That's hitting 2 birds with 1 stone. The Quant Tax Plan has assets under management of 3,533.36 crore rupees. The minimum investment required is only 500 rupees. Its expense ratio is 0.57%. In the last 3 years, its CAGR is 46.7% compared to 26.5% of the Nifty 50. And in the last 5 years, it has delivered 23.2% CAGR compared to only 11.1% of the Nifty 50. As you can see, the ELSS version has delivered even better returns. Some people might not feel confident about investing in Quant mutual funds because their AUM is not very high and that might create liquidity concerns. For those people, there is another great option, the Mirai Asset Tax Saver Fund. Mirai is a global financial services group headquartered at Seoul, South Korea. It has assets under management of around $200 billion in 51 countries. The fund in India has an AUM of 15,218 crore rupees. The minimum investment required is 500 rupees. Its expense ratio is 0.45%. It has delivered a 3-year CAGR of 32.77% compared to 26.5% of Nifty 50, and in the last 5 years, it has delivered a CAGR of 16.15% against 11.1% of Nifty 50. If the lock-in period of 3 years is an issue, then the other option is Mirai Asset Large Cap Fund. However, there is an exit load of 1% for this fund, which means if you decide to sell out before 365 days, you will have to pay 1%. The 3-year and 5-year returns for this fund is lower than its ELSS version. Flexicap Funds. A Flexicap Fund is one which allocates capital to large, mid and small cap stocks, and there is no limit on what percentage can be allocated to each category. Flexicap funds try to follow the latest themes and invest based on the capital cycles. These cycles can last for more than 5 years, so it's tricky when to enter and when to exit Flexicap funds. So before investing in a Flexicap fund, it is very important to decide the time horizon for our investments. One very famous or very much promoted fund in this category is the Parag Parikh Flexicap Fund. This fund has done really well in the past, but I fear its best days may be gone. It has heavily invested in US tech stocks, which are usually quite overvalued. This overvaluation of the US tech stocks has happened largely in the last 5 to 7 years. I personally do not see much future growth in US tech stocks, many of which have already reached close to $1 trillion valuation. People who have invested into this fund in the past and are sitting on large profits may not have much to worry about, but as a new investor, I would not prefer investing into the Parag Flexicap Fund, debt funds. One of the most important aspects of safe investing is diversification into various asset classes. Having debt assets in a portfolio is extremely important, yet it is rarely talked about. The famous book, The Intelligent Investor, broadly classifies investors into two categories: the defensive investor and the enterprising investor. The defensive investor should invest 50% of his capital in equity and 50% in bonds. The enterprising investor should invest up to 75% of his capital into equities and at least 25% should be invested in bonds. The rationale behind this strategy is very simple. In times when stock markets are under stress, bonds not only protect your capital but also generate inflation-beating returns. Plus, you have the opportunity of selling bonds and buying equities at dirt cheap valuations during a crash. Recently, tax benefits for debt mutual funds have been removed, and for that reason, everyone is ignoring debt mutual funds. That could be a big mistake for retail investors. Even without those tax benefits, debt mutual funds still have many advantages. For example, directly buying a bond is quite expensive. In many cases, the minimum amount required is 10 lakh rupees. Plus, when you receive annual interest payments, those are taxable. In debt mutual funds, you can start investing with only rupees 500 and you won't have to pay any tax until you sell the units. This way, investors can gain from compounding just by holding. Another advantage of buying debt mutual funds as opposed to buying bonds directly is diversification. Debt mutual funds can help you build a diversified portfolio of bonds starting at just 500 rupees. So for debt funds, which option is better? SIP investment or lump sum investments? I personally prefer investing lump sum in debt funds, and let me explain why. Consider we are in a raging bull market and my equity mutual fund is at an all-time high. So I would sell some of my equity mutual funds and put the money into a debt mutual fund. At the next market correction, the debt mutual fund will start growing really fast. That's the best time to sell it and put the money into my favorite equity mutual fund. So which debt fund to choose? I am investing into two funds, the HDFC Corporate Bond Fund and Axis Banking and PSU Debt Fund. I make sure to choose the direct growth versions of these two funds. The next in the category is Balanced Advantage Funds. If all this reallocating between bonds and equities, depending on market conditions, is too complicated for you, you can simply go for a balanced advantage fund. These are also called hybrid funds. A balanced advantage fund will do the reallocation for you at the right time. One advantage of investing in balanced advantage funds that I really like is that I don't have to pay any capital gains tax for the purpose of reallocating because I am not selling anything. And professional fund managers are better at timing the market cycles than most retail investors. My pick in this category is the HDFC Balanced Advantage Fund. Even in the extreme volatile market, this fund has generated a very impressive return of 20.47% in the last 1 year. This fund has an exit load of 1% if you sell before 1 year. The next category is small cap funds. I have not yet invested in any small cap fund and I prefer staying away from them most of the time. Let me explain why. Small cap investing is basically multi-bagger investing, and if we want to get multi-bagger returns, we must follow certain principles. Building a concentrated portfolio being one of those principles. Out of the hundreds of small cap stocks listed in the market, maybe only 5 are capable of generating 100x returns. Multi-bagger stocks are that much rare. What small cap funds do is invest in a diversified portfolio of around 100 small cap stocks. It's obvious that most of those stocks are going to underperform. When it comes to investing into small cap stocks, big fund houses have a big disadvantage. That is, most small cap stocks do not trade in very large volumes. So even if a fund manager finds a small cap stock with 100 bagger potential, he may have to ignore it. Because if he chooses to buy the stock just because of his buy order, the price of the stock would skyrocket. And without enough volumes, he may not find enough sellers to exit the stock. Small cap stocks could be a one-way ticket for institutional investors. For these reasons, I prefer buying small cap stocks directly from the market and not through mutual funds. However, there is one situation in which investing into small cap funds could be very wise. It's after a big market correction. In a big market correction, large cap stocks might correct by 20 to 30%, but small cap stocks might correct by 60 to 70%. So if prices of small cap stocks fall from 100 rupees to 35 rupees, our investment in small caps would give us a return of 185% when prices recover back to 100 rupees. The small cap fund that I would buy in such a scenario is Nippon India Small Cap Fund. It has assets under management of 26,293.5 crore rupees. The minimum investment required is 5,000 rupees and its expense ratio is 0.82%. The last 3 years CAGR returns for this fund is 52.33% versus 26.5% for the Nifty 50. Please type in the comment section what is your strategy for mutual fund investing. Thank you for watching the video and have a nice day. I'll see you in the next one.